Welcome to Investing Basics, and today we'll have a look at the bonds asset class in a little bit more detail. Now, just to start off with, bonds are very basic at the core. Obviously, there are quite a few aspects that make the asset class a little bit more complex, but for simplicity of the video, we'll stick to the basic characteristics just to give you a sense of how bonds work in the marketplace. Now, bonds form part of the capital market alongside equities due to their maturity being longer than 1 year. They do have a wide range of maturity profiles spanning between 1 year and 30 years, but there are some instances where bonds do have a maturity of more than 30 years. Bonds can be subjected to two types of rates: variable rates and fixed rates. We won't delve into this in too much detail, but it really just gives you a sense that there are two applicable rates that we can receive on bonds. And then finally, as part of the introduction, bonds can be issued by various institutions. These include governments, parastatals, and corporates. Quite an important aspect of bonds is the inverse relationship that exists within a bond. The inverse relationship exists between interest rates and price. And just to give you a little bit of an example, when yields increase, the price would decrease, and that just shows you the inverse relationship of a bond. There are various aspects that contribute to the degree that the price would be impacted when interest rates change, but we're not going to delve into this into too much detail. But just to give you some sense of the aspects that would impact the inverse relationship is duration, and then also the ratio that we have between coupon and yield, especially yield to maturity. The graph on the screen at the moment is quite a powerful representation of the inverse relationship, and this is a real-world example of data that I've pulled of a 10-year government bond. And this just shows you in most instances when interest rates decrease, the price would increase, and conversely, if the price was to decrease, the interest rates would increase. And this just gives you a sense of the inverse relationship that would actually exist. Moving on to the risk factors of bonds, and let's start off with interest rate risk. As we have mentioned, there is an inverse relationship, and the interest rate risk is quite a big one within bonds. Secondly, there is a risk of credit default risk, which basically means that the counterparty can't repay the money that was invested, which is quite a big risk in the bond asset class. Inflation risk, especially when inflation starts to increase, this would basically mean that your real return would diminish as inflation increases, which shows that inflation is a real risk to bonds. And then finally, it's the sovereign risk, which just kind of ties into the credit risk or the default risk of the country. When we have a look at the bond characteristics, and especially the basic bond characteristics, just to give you an example, the investor buys a bond, and that investor would usually buy the bond at par value, but there are instances that the investor could buy it at a discount or at a par, and we'll discuss this in a little bit more detail in other videos. The investor would then receive a coupon or income or interest, as we would call it, and this usually is paid on a semi-annual basis. At the end of maturity, this will be a specified maturity. The face value or par value would be paid back to the investor. And as we've mentioned previously, there is some capital vulnerability, especially when we do have a situation when interest rates change. Let's just have a look at a quick example. If we say take a 10-year government bond, let's say that the government bond then yields 8%, or the coupon payable is 8%. After tax, we would receive 4.8% return, and if we then bring 5% inflation into the mix, it basically shows that we are farming backwards in real terms. Having a look at this chart, this basically just spells out exactly the returns example that we've just indicated, and it just shows you that over a 10-year horizon, the bond doesn't beat inflation. And what is very important here is that we haven't taken into account any of the interest rate changes. This purely is just to show you the return profile on the yield or the coupon that is paid on that bond. Then in summary, bonds form part of the capital market. They are income generating assets and they are quite an important asset class, especially as people start to move into their retirement phase and especially when they start to demand a higher income from their assets. Bonds, like equities, have the right time for us to buy the asset class, and this is very, very important, especially when we link back to the inverse relationship that exists. Just to bring in an example as we end off, you would like to buy a bond when rates are falling, and you would like to reduce your exposure in bonds when rates are rising. When we have a look at the current state of markets with interest rates at all-time low, we see that we would like to reduce our exposure to bonds currently, especially as we see interest rates starting to tick up a little bit higher. Thank you very much for watching this video. We hope that it was of value to you. We would welcome you to watch any of our other videos. Please go to our website or our YouTube channel. And we would just also like to point out that this video was created purely for educational purposes and should not constitute financial advice. This video was brought to you by Kerner Perspective and KP Fiduciary Solutions. Thank you very much.